How are the markets doing today, Andrew? Because
Thank
just
you.
when we thought, some reprieve was coming through, we had the JSE moving off its lows that were hit earlier on in the session, deep into the red, and very much on account of the latest bit of economic data we've seen filter through from the US.
It's been a bit of a seesaw ride today. I think you saw the markets open a lot lower. I think that's on concern on what's happening on both sides of the Atlantic Ocean. In the US, we saw poor economic data coming out of there. We know the whole debt, US debt ceiling being raised, etc. Government spending is going to be cut. We saw poor spending money coming out of the consumer. So I think there's a real threat that the US could fall back into recession. And then obviously on the other side of the Atlantic, you've got the European debt problem. So, it's not good news. There's poor sentiment. People are very risk averse at the moment. And hence we've seen the gold shares doing very well.
Absolutely. And, we're dealing pretty much with double-edged swords, if we can call it that. I mean, let's focus in on the US because efforts are being made to cut spending and it needs to be done. But what this means for the global economy is of concern, where there's no one really to take the place of the US in the consumer market yet and drive demand. And that really the double-edged sword we're facing at this stage.
Yeah, exactly. As I said, the threat's very real. I think this double dip recession that's been spoken about for the last year, I think. It could be just around the corner. But having said that, the US equity market doesn't look too badly priced. It's actually looking quite attractive. They've had a very difficult or tough 2 weeks. I think they've been down every day in the past 10 days, I think. And from the beginning of the year, they're about 8 or 9% down. So it's offering fairly good, it's at attractive levels for the investor.
So let's get into your approach to the markets right now. Let's start off with that offshore versus local exposure debate. I mean, how are you positioning in terms of that?
I think at the moment you're seeing very good value coming out of the developed markets. We've just touched on the US. We've seen the company earnings, they're not too bad. Towards the earlier parts of this year, the company earnings, we saw Apple's, they were very good. They were coming in ahead of expectations. Likewise in Europe. What you can buy very attractive stocks, Spanish and Italian stocks that get their earnings from around the world, from emerging markets, but yet they've been priced as Spanish or Italian stocks. So they've been priced very attractively, but the earnings are coming from your emerging markets, Brazil, China, India, etc. So I think developed markets are looking attractive. Emerging markets, they've had a big run up through last year and into the beginning of this year. So they're looking a little bit more on the pricey side. So at the moment we tend to the developed markets.
Let's nevertheless look at the South African markets today. I mean, no big surprise that we've got those gold miners at the top of the top 40, Anglo Gold and Harmony right at the top with over 3% gains today. And very much on the back of that rising gold price, we know that these players are highly correlated to that price at this stage.
Yeah, the problem for value manager, we're a deep value manager, and to try and value a gold company is very difficult because it's hugely cyclical. As you said, it depends on the gold price. So what the earnings did last year has nothing to do with what the earnings are going to do in the year ahead. So it's very difficult. So for us, we tend to stay away from the gold miners. Gold's also not a productive asset. If you bought an ounce of gold in 1970, it's still an ounce of gold today. It hasn't done anything. It hasn't produced anything. It's very much a speculative, or let's say when people are pessimistic, that's the first place that they flee is to gold. Platinum, on the other hand, is a good proxy for gold, I think, and it adds value in the term the use of exhaust. We know what's happening in China and India, the number of cars that have grown. So at least there's an investment case for platinum at the moment, whereas gold, I think it's more speculation. So we tend to stay away from gold.
Of course, we've got Lonmin up 1.7%. Implats, though, trading in negative territory and still very much shrouded by all the industrial action and the noises there and what that could mean for cost pressures moving forward.
Yeah, obviously it's not good news for any of the platinum producers. At the moment, as I said, we prefer platinum to gold. We don't hold any platinum either. Platinum mining, Northern's got the deepest mines. It's very expensive. Electricity costs are going up. They're not on attractive levels at the moment. Even if you look through the cycle, if you take the 7-year earnings on platinum or gold counters, they don't look that attractive to us. So although we prefer platinum, we're not invested in either platinum or gold stocks.
So as a value manager at this stage, when it comes to the South African market specifically, where would you be delving in right now?
We've been overweight construction shares for a long time. We're probably a bit early there. The banks are putting through nice numbers at the moment. You've seen the banks normally trade in a price to book of around 2 times. At the moment, they're trading at a big discount to that. So we overweight on the banks, and then the technology companies also look fairly attractive. What's very interesting is if you look in the industrial sector as a whole, when you take a cyclically adjusted P ratio, look at earnings through the cycle, and you look at what the industrial 25 index, which is mainly your large multinational companies, your NASPAs, those sorts of companies, Richemonts, SABs, that index looks very expensive. It trades on a cyclically adjusted P ratio of about 20 times. When you look at the industrials index, which is more your homegrown industrial companies, your construction companies, your Grindrods, your packaging, Transpaco, Winholds, those sort of companies, you've seen them on a cyclically adjusted P ratio of 12 times. There's a gap of about 8 times, which is the biggest or the widest the gap's been in the last 25 years. So though industrials as a whole look fairly expensive at the moment, we actually seen quite a bit of value in these homegrown industrial companies, if I can call it that.
Yeah.
So that's where we've seen the most value at the moment.
Would MTN fall into that group? Because today getting hard head down close enough to 3%, it's currently trading at 141 Rand 49.
I don't think MTN looks that expensive. I don't think it's not a screaming buy by any stretch of the imagination. In that space, we prefer Vodacom and Telkom. I think Vodacom dividend yield is exceptional. They pay, I think, a dividend yield of somewhere around 6%. So those are the two telecommunication companies that we would favour as opposed to MTN at the moment.